NVIDIA. Market's up big today. NVIDIA's moving, as you know. Let's look at our strike prices for trades if you were considering a bullish trade in NVIDIA. Now, with NVIDIA trading right about $104, we're going to look at something in the diagonal family, called diagonal, taking a bullish posture in NVIDIA. Going out to the May 16th expiration. Remember, NVIDIA has earnings on May 28th, so we're still ahead of earnings. That won't be the case in Meta Platforms, but in NVIDIA, not till May 28th. So we're going to go out to the May 16th expiration by the 103 call. Look at the expected move. Remember, we're midweek already, so you've got to start to tighten up those strikes because the expected moves are coming down ever so slightly. Using that right column on the Thinkorswim platform. Selling the April 25th 107 call, so only $4 wide on this diagonal. We put that in around $5.05, trading about $5.20 right now, $5.15, $5.20 range as the stock has moved slightly higher. So the risk on this is whatever the debit paid. You're looking for a move. Remember, the move for the rest of the week in NVIDIA is still $9. I'm sorry, nope, that's not, that's next week, $4. That's why we've got that lined up a little inside that. Could you do the 103 or 104, 108? Of course you could, yes. But for this, remember, the most important thing is the strategy. So the 103, 107 call diagonal in NVIDIA, trading about, about $5.15, $5.20 range. You're looking for a move towards that 107 strike, and the risk on this trade is the debit paid. You're collecting theta. You're long about 27.5 deltas in NVIDIA per each call diagonal.
NVIDIA's market valuation has increased by over $2.2 trillion since the start of 2023, thanks to the artificial intelligence AI boom. The company's graphics processing units, GPUs, the gold standard for creating AI models, are in high demand for the data center. Some of the largest computer firms in the world, like as Microsoft, Amazon, Meta Platforms, and Alphabet, are NVIDIA's clients and are engaged in a competition for supremacy in artificial intelligence. It is anticipated that these four businesses would invest a record sum of money in data center infrastructure in 2025. However, NVIDIA CEO Jensen Huang predicts that spending will rise sharply annually for the foreseeable future, surpassing a critical milestone in 2028. This is where the company's stock might be in 3 years as it keeps releasing new chips to keep a competitive edge. The H100 data center GPU from NVIDIA controlled the market in 2023 and for the most of 2024. The company's Hopper architecture served as its foundation. However, Blackwell and, more recently, Blackwell Ultra have since replaced it. In some combinations, the next Blackwell Ultra GB300 GPU can outperform the H100 by up to 50 times, because it was made for next-generation AI models that can reason. Chatbots, such as OpenAI's ChatGPT, used to be helpful since they could swiftly provide one-shot answers to users' questions, but sometimes they would give out false information. In order to produce more refined solutions, reasoning models take extra time to reflect and fix any possible mistakes in the background. This presents some new difficulties even if it is a huge advancement for the AI sector. According to Huang, there are two reasons why reasoning models need an astounding 100 times more processing power than their predecessors. First, because to all the background reasoning, they utilize 10 times as many tokens as conventional large language models, LLMs. Second, they render responses significantly more slowly. Therefore, GPUs must be up to 10 times more powerful to compensate for the delays. Otherwise, AI would lose the convenience that people have come to enjoy. New chips built on the Blackwell and Blackwell Ultra designs are therefore highly sought after. Microsoft, Amazon, Meta, and Alphabet, the four NVIDIA clients I listed at the top, have informed investors that they intend to spend a record $300 billion combined on data center processors and infrastructure this year. This excludes additional high spenders like Oracle, Tesla, and OpenAI. However, Huang believes that this is only the beginning, as he projects that data center spending would surpass $1 trillion yearly in 2028, 3 years from now. This would be a huge boost to NVIDIA's business. During its fiscal year 2025, which concluded on January 26th, NVIDIA made a record $130.5 billion in total revenue. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video.
Stacey, there's one question that I imagine many of our viewers want to know, and that is whether they should buy Nvidia right now, given all of this and given the drop.
I mean, look, we still like the fundamental story. I like the story around AI demand. I still think that they are by far the winner in this space. I mean, but there's clearly like more uncertainty around everything. And again, like I said, it's not just Nvidia. Like it's, right. I mean, it's down a lot this year. The whole semiconductor industry is probably down, not quite as much, but almost as much as Nvidia. I mean, the sector's just gotten wrecked on all the tariff stuff. It's just one of the most global sectors that's out there, and it's both directly and indirectly, it's exposed and they get impacted. So my issue is right now, I don't know when all of this eases, but the thing is, it could ease tomorrow. It could ease literally with a tweet.
It could, although then another tweet will probably send it back down again.
Probably.
Such are the times we live in, Stacey. So hope you're doing lots of yoga or something. Good to see you.
You try to find it where you can, but like I have to put safe harbor like statements on my notes now. They're only accurate as of the time of publication. Like things are changing very quickly.
We are all trying.
GPU demand is increasing at a rapid pace, as evidenced by the data center market, which accounted for $115.2 billion of that total, a staggering 142% growth from the previous year. With its earnings per share, EPS, rising 130% to $2.99 in fiscal 2025, Nvidia's booming top line also contributed to a notable boost in profitability. As a result, its stock is trading at a price-to-earnings PE ratio of just 39% below its 10-year average of 59.6. However, looking ahead, the stock appears much more affordable. Nvidia's stock is trading at a forward PE ratio of 23.9, according to Wall Street's average forecast that the company will generate $4.42 in EPS during the current fiscal year 2026. To put it another way, Nvidia's stock would need to rise by almost 149% over the course of the following 12 months in order to trade at $263 per share, which is in line with its 10-year average PE ratio of 59.6. However, based on Wall Street's profits projection for fiscal 2027, which ends in January 2027, the stock may still reach $200 even if its PE ratio stays at 36. Therefore, Nvidia's stock should be trading far above $200 in 2028, provided that it continues to generate modest yearly earnings growth after that. Given Huang's $1 trillion data center spending plan for that year, the business should have little trouble increasing its profits. Because of the brewing global trade tensions that could soon stifle economic development, Nvidia's stock is down 29% from its all-time high, which is why the company's PE ratio currently seems so appealing. A slowdown in their main operations could compel some of Nvidia's largest customers to temporarily limit their data center spending, which would lower demand for GPUs and hurt the company's profits potential. However, AI is expected to be a long-term boom, and without the hardware provided by firms like Nvidia, the sector cannot advance. As a result, investors who purchase Nvidia stock now may experience some volatility while the United States negotiates new trade agreements with other nations. But if they ignore the noise and keep their eyes on the future, they may do very well. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
There's something really important about the keeping Intel around and keeping TSMC around, right? These are the only two companies doing leading edge semiconductor manufacturing, research and development, as well as Samsung. But you can't just merge the companies together. You can't just bring together technology, right? In any sort of collaboration, one of them would come out on top. But there are some opportunities, right? Intel, with their new CapEx numbers, they were planning to spend over $30 billion if you go back 2 years, this year, right? And they're going to fill out this fab in Ohio. They have this massive fab in Ohio that they're building out. But they've paused, right? They're not going to fill it up with tools. So, and that's a big chunk of the CapEx reduction, right? And there's other CapEx reduction across their other manufacturing facilities. Well, now there's an existing fab ready to move tools in, could go into production in 1.5 years or 2 years, but Intel's not going to do it, right? So there's a possibility for TSMC to say, hey, we want to get away from tariffs. We want to, we want to somehow fill this up with our manufacturing equipment that we're buying, the process technology that we've developed, and actually be able to manufacture in America. Now, the U.S. government is obviously going to want this, right, to move production more and more to the U.S. TSMC's massive announcements in Arizona, the new $100 billion, will take 4 to 5 years to even come to fruition, right, because they don't have any fab buildings. The fab building takes 3 years to build, and then the fab takes a year or two to fill out. But most of the cost is in that filling out of the fab. So yes, TSMC can announce $100 billion of spend, but you're just building the buildings without putting the really expensive lithography tools from like ASML and all these other companies. So TSMC's announcement is effectively irrelevant to the current administration, right? They want fabs now. And there's only one way to build a fab in the U.S. that goes into production in 2 years from TSMC in humongous volumes, right? It's that Intel Ohio site.
And of course, when we're talking about Intel, we are talking about the foundry business that seems to have a lot of struggling years. Do you see that to turn around in any time? And we're talking about, of course, the Trump administration wanting to keep its own American semiconductor manufacturing capabilities alive on its soil. Do you see that happening in Intel?
Yeah, so the big thing here is even if TSMC builds all the fabs in the world, all the fabs in the future that they're going to in America, without Hsinchu, Taiwan, which is where TSMC does all of their R&D, these fabs become, they don't advance in technology. They effectively become, paperweights after a few years, right? So the U.S. has to maintain some sort of R&D in America as a policy interest, as a national security interest. Now, TSMC can do this Intel can do this in a number of ways, but the challenge with their foundry is they don't have what's known as a process development kit. You can think of this as companies have a really hard time designing for Intel process technologies, even if Intel's fabrication and process technology was better than TSMC's. Which it potentially could be in the next couple of years. There's actually some really interesting technology. The way to design for those chips is actually near impossible, right? And this is where Lip-Bu Tan comes in, right? He's a really disciplined allocator of capital. He's extremely technical. He's going to cut out all the BS on the chip side. But really important is he's going to be able to help Intel make it so their process technology is actually something you can design on, right? Because Lip-Bu Tan's history is cadence, right? This is what he does. He's built one of the largest companies that does chip design software in the world. So EDA software, right? So this is exactly what Intel needs. And if he can fix this part of Intel, Intel's not as far behind as they've been.
So far this year, Nvidia has been losing ground. As of this video, shares have fallen by around 30% so far this year. Nevertheless, over the last 12 months, the stock has increased by more than 27%. With a market valuation of over $2.4 trillion, the leader in artificial intelligence, AI, is still among the biggest businesses. Investors are wondering if Nvidia's stock can pick up steam and propel the business back to a $3 trillion or higher value. I think it can, and May 1st is a crucial day to keep an eye on. There are a number of reasons for the recent drop in Nvidia's stock price. The stock's more than 800% rise for the 2 years ending December 31, 2024 was the most evident. Some investors' desire to safeguard their riches is understandable. However, attempting to time stock prices might be risky for one's financial well-being. If the company's fundamental business prospects continue to be favorable, it is best to leave long-term investments alone. This leads to yet another obstacle for Nvidia's stock: tariff-related uncertainty as well as the overall demand for AI infrastructure. The U.S. government recently imposed indefinite limitations on the company's sales of H20 chips to China, forcing it to accept a $5.5 billion charge. Since such chips were created especially for the Chinese market, other Chinese chip suppliers, possibly even domestic ones, will unavoidably take that market. Even while Nvidia's sales in China are significant, they only accounted for roughly 13% of overall revenue in the fiscal year 2025. The trend of demand from big tech companies like Amazon, Microsoft, and others for their AI technologies is more important. That is now being questioned as well. A Wells Fargo analyst note stating that Amazon Web Services, AWS, had postponed earlier plans for new data center leasing has been echoed in recent news. The analysts claim that Microsoft, another major supplier of cloud infrastructure, has taken similar actions to halt the growth of its data centers. This comes after a number of businesses revealed intentions to significantly increase the capacity of cloud infrastructure by investing hundreds of billions of dollars in Nvidia's GPU hardware. Others, like Meta and xAI, seem to be sticking to their expansion strategies. Andy Jassy, the CEO of Amazon, has previously stated to CNBC that he would not anticipate reducing capital expenditures for data center computing capacity. Investors should therefore put May 1st on their calendars. On that day, Amazon is expected to release its first quarter financial results. The day before, Microsoft will release its quarterly update. Kevin Miller, Vice President of Global Data Centers at Amazon AWS, referred to any change in plans as routine capacity management. Investors may reinvest in Nvidia stock following its recent decline if the companies reaffirm that their capital investment plans are essentially on track. According to current fiscal year earnings predictions, Nvidia's price-to-earnings (PE) ratio is currently close to a 3-year low. AI's long-term development does not appear to be coming to a standstill. Both consumers and businesses should use it more. Furthermore, Nvidia's revenue streams extend beyond AI hardware. Businesses are purchasing its strong software architecture products. Additionally, it features a rapidly expanding robotics and assisted driving market. Spending by businesses may vary. The rate of AI growth could be slowed by a downturn or even a recession. However, Nvidia continues to lead the industry. Its current stock price will likely be remembered by long-term investors as a good investment opportunity. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Good old Nvidia. Jensen Huang, are you a believer in Nvidia?
Well, we're believers in Nvidia. You have to take into account that they have quite a large moat in terms of their technology and process and the complication that they have with their so-called chips. They're not really chips; they're computers in and of themselves, systems. They have been a bit capacity constrained, and that's been one of the slowdown type issues. And they have also had the misfortune of being caught in the crossfire with China and the H20s and whether, what kind of chips we're going to be able to send over there. And they had to take a big write-off for that. But the AI need for high-end processing power, regardless of what people may think with regard to DeepSeek and these models that work with other models, you're going to need the high-end chips and lots of them. So we're believers that they're going to be able to continue to grow their revenues. And right now, at 106, 105, you're getting it at one of the cheaper prices you've ever been able to get it at since the AI theme began.
If I want to make money in a year or so and I had $10,000 right now, what would you tell me to do with it, Thomas?
Oh my goodness, what a great question. Because of the uncertainty, I would still have that invested in a diversified portfolio. And if you were going to buy one thing, the S&P 500, which has been a bit out of favor, I think, lately with a lot of folks, whether it's sell the U.S. or U.S. exceptionalism is waning, or there's too much of the Mag 7 in there. It's still a nice amalgamation of U.S.-centric companies that are growing and can offset each other depending on the scenario. So that may not make you the most money in the next year, but it will probably protect you somewhat in the event that things aren't as rosy as we might hope. We're kind of stuck here in a no man's land between the 55 level on the S&P and whatever the low was in the past, and still a lot of uncertainty about that. So conservative positioning, not making too big a bets, and watching and waiting to see what really happens with tariffs.
Yeah, that low, 48.35 on the S&P 500 a couple of weeks ago. And so the question, too, is whether or not you need to go and retest that low before you really say that the low is in. What say you?
Well, it's likely that we will test that low. It really, the technicals are favoring a bounce here, and we've had a little bit of that, but it's faded, and it doesn't look like there's enough steam at this point using the fundamental information to get above that. So the technicals are being driven by the fundamentals for now, and what the expectations are for tariffs. So when the news is positive and we're laying off of that, then the market can rise. But 50% tariffs would still be very high, and we're only at the beginning of companies telling us how it's affecting their business and their consumers.
Yeah, it's only the beginning because there's so much uncertainty, too. We don't know exactly what to expect when it comes to the tariffs. Are you feeling more glass half full or half empty between now and the end of the year?
Well, I guess I'm almost exactly glass half full empty. It's right there in the middle, and it depends on the man with the pitcher in his hand as to what happens. We think that we can get through a lot of, maybe much of this uncertainty in terms of actual deals and see what the framework is and see how companies are reacting by the end of the year. People want to own stocks, and I don't think we're over that part of the economy. They can still have a good rate of return. We're expecting decent earnings, although it's been less than what was expected before. So we are hopeful that with some good news, we can see a market that's up for the year.
And so you are bringing us some stock picks today. I'm excited to speak about these. And how do you go about planning a portfolio? Before I get to the exact names, how do you go about picking the stocks that go into a portfolio? Having an allocation, are you keeping cash on the side? What's the investment strategy?
Well, for our equity portfolios, we believe that if people give us money for equities, they should be invested in equities. And so for the most part, we keep cash frictional. Our process is based on good fundamentals, good earnings, companies doing better or at least better on a relative basis than the other alternatives. And we hardly ever have a hard time finding companies that fit that bill. At this point, we want to be pretty well diversified among the sectors and not make too big a bets.